Good afternoon, everybody. Going to go over our Forex trades for today, Monday, December 14th. Hopefully you had a good weekend. No economic news to go over. We did have one trade which we lost 7.1 pips on a size-adjusted basis, what you're seeing there. We did have a second trade which happened later in the morning. We'll go over that trade in tomorrow's video. First, just wanted to talk real quick about, we've been so negative on the housing market, and we came across some data. We had talked about this previously, close to a year ago, but the updated number has increased. So it was, I'll just read it off. It's just one sentence. It says, when the housing bubble burst in 2007, the total notional value of derivative contracts around the world stood at just about $500 trillion. Today, as of a week or so ago, it's topped $800 trillion. So, as you know, as we just said, as you know, we're very bearish on the housing market, and this is not a good sign. And it wasn't a good sign when we talked about it close to a year ago, and it's only increased. So we all know what happened in the housing bubble of 2007. Maybe the housing bubble is not as big this time just because of the bubble itself didn't blow as big because you didn't have as much lending after the financial crisis happened. But you did have hedge funds in there buying, which they've stopped. We've talked about that. The problem with the derivative contracts is on these banks, on the bank balance sheets, JP Morgan, Goldman Sachs, Bank of America. If you get a black swan event that occurs outside the norm of risk, which happened in 2007, it creates an implosion, right, of all different types of the investment products, and that's what we saw in 2007. And now we have derivative contracts not quite double what they were on the bank's balance sheets, but 300 trillion higher than they were in 2007. And on top of that, you have student loan debt over 1.1 trillion. So, if you get this implosion, if you get this black swan event that creates an implosion, we already have in the past few days, we've had high yield bonds, or you want to call them junk bonds, absolutely cratering. And this could, who knows, I don't think it'll be the start of a black swan event, but you never know. And if it all starts, and if the banks have to do something with these derivative contracts, all it does is just add fuel to the fire, just as it did in 2007. So I'm not that concerned about the overall stock market or the U.S. dollar. I'm more concerned about the housing market than I am, the stock market. You saw how much the stock market came back from the financial crisis of 2007, which, by the way, was the deepest recession since the Great Depression. Not only did the Dow come back, the S&P 500 come back, but the Dow was as low as about 7,400, and it ran up to 18,000. So it went up more than 100%. Granted, before the fall back to 7,400, it was around 11,000 or so, 12,000, but it has far surpassed what it was before the financial crisis. So because you have the Fed on the stock market side, you have the Fed on the dollar side, whether they're, the Fed's going to move the dollar, right? So if they want to start raising rates, it's going to be bullish for the dollar. If they have to reverse course next year and they start to lower, it's going to be negative for the dollar, and we all know it. Stock market, the Fed's on the stock market side, so as an investor if you're an investor in the stock market, you don't fight the Fed, right? So you have the Fed on your side. Are there corrections? Of course. Could there be a 10, 20% correction? Absolutely, right? But the housing market is a big outlier because the housing market affects all of us, right? In some form and fashion, where the stock market doesn't. you have people that invest in housing, they flip houses, they buy them for rentals, and then you have people that live in them. You have people that buy apartment buildings and rent out the apartments. So, and those people that rent, they live in those apartments. So you have a situation when talking about housing, it affects nearly everybody in the country. So, and actually in the world, because you have to live somewhere, correct? So that is my biggest concern. And when housing gets hit, it affects the economy in a big way, as it did in 2007. So, and as I said earlier, I don't think the bubble in housing is as big as it was prior to 2007. You know, banks were not lending. They just started lending recently in a little bit more aggressive way than they were, you know, since it all happened. So, not too concerned about as the bubble popping as big as it did in 2007, but I am concerned, and I do think housing's set to come in. And I've been saying that for, you know, close to a year, or maybe more than a year. Sooner or later, I know I'll be right. So that's just a matter of time. But no economic news really to speak about, other than I just wanted to bring that up. The one trade we had was really the oil. Affected this, as the oil affects the Canadian economy in a big way. Oil was down near day lows when we actually got the signal to go long US dollar Canadian dollar 1.3768. Oil had a small bounce, or well, not a small, a pretty good bounce, intraday bounce, and it caused the US dollar to tank and the Canadian dollar to rally. So therefore, you see the spike down. We got stopped out, losing 71.4 pips, or 7.1, as we only had 10% of our normal size, just because we're coming into the Fed meeting is Wednesday. So 2-day Fed meeting starts tomorrow. Don't want to be risking, you know, 20 pips on something. Maybe a full scalp, and even then, you know, the second trade we did later this morning, considering we're leading into tomorrow, we took half our normal size. We're going to take half our normal size tonight and tomorrow morning. Won't be even trading on Wednesday just because of the Fed. So you don't know if something leaks out from their meeting or whatever. So, you know, no sense taking a chance. Market's probably going to be very choppy until, until the announcement on Wednesday afternoon by the Fed. Currently about 72% chance that the Fed raises rates. So we'll see what happens. I would think they're going to. Anyway, so that's it. You can see what it did. It stopped us out, went down about another 20 pips after it stopped us out, and then popped. Came all the way back, not quite even, but we'd still be down if we didn't get stopped out. But we'll move on with it. We didn't get beat up too bad. And the second trade we had was later this afternoon, was in pound to yen, which we'll go over in tomorrow's video. So we picked up some pips there, kind of chopped into this loss a little bit. Anyway, so that's it. We're gonna wrap it up. If you're still trading now, good luck. If any signals come out, they'll be coming your way. And we'll be back tomorrow with the late morning action, and then any action tonight and tomorrow morning. Have a great rest of your day.